So I'm discussing about SEBI. So SEBI is the Security and Exchange Board of India that was established in 1988 and investor risk reduction assess platform. This is working with Bombay Stock Exchange. So this platform reducing risk of the investor, eventually technical glitches also. Available to trading members supporting interest-based trading and security, internet-based trading and the security. So it is jointly developed the BSC, NSC, National Stock Exchange, MCS, Multi-Stake Metropolitan Stock Exchange of India, and this was established in 1988, and this body is a statutory body in 1992. So this is Security and Exchange Board of India. A chairman is appointed by the central government, and four full-time members are there, and four part-time members are there. And this is there is a one member from RBI and five members from the Ministry of Finance from the central government. Now, function of the SEBI to protect the investors, to regulate the business of stake exchange, to prohibit the insider trading, to registration, regulation, and the stock broker, sub broker, share transfer agent, just registering and regulation of that, and promoting the education and training of the investor. It is a quasi legislature body and quasi judicial body, regulate the money scheme up to 100 crore rupees. Okay, and can seek the information, can undertake the disciplinary proceedings, and can issue the directions also. So what is the SEBI? So see, the recent initiative taken by the SEBI, that is timeline for the initial public offering. What is the initial public offering? When new companies listed in the SEBI, that is take some shares in the market, and up to 6 days to 13 days, 6 to 13 days shares they come there in market. T plus 6 and T plus 3 is there. So this share is known as the initial public offering. So this refer to the selling of the security to the public in primary market. So this is a primary market. Okay, this is a primary market, and it acts as a largest source of the fund of the company. Okay, so ease of doing business will be facilitated with the initial public offering. Now next is core framework, that is the SEBI introduced the BRSR core framework. This framework are helping in the environment social governance, is a framework that has the stakeholder understand how the organization is managing the risk. So how the organization is managing the risk, so that's why this organization came. So SEBI is amending the Security and Exchange Board of India, that is listing and the disclosure of the requirements. So first is business responsibility and sustainability report, and this is the business responsibility and sustainability report. Okay, this report is based on the key performance indicator and this relevance of the Indian emerging markets, and KPI means some index are there, like key performance indicators. These indicators may be openness of the business, gross wages paid to the women, small town business. So this all included in the business responsibility and sustainability report. After then, one more initiative, ESG disclosure and the value chain. ESG is what it is a will be applicable to 250 listed company. So this will be for the 250 listed company, and will made listed company as a BRSR core. BRSR means this is a business responsibility and sustainability report, and value chain shall be encompasses top upstream and downstream partners. So this is ESG disclosure, and the value chain is also a new initiative. Now related issue. One issue is the Dabba trading. Dabba box trading. What is the Dabba box trading? So, see, Dabba box trading is from the NSC, National Stock Exchange, issued the notice naming the entity involved in the Dabba trading. So, naming the entities. This is informal trading. What is this? This is a informal, not a formal chain. It is not in a formal chain. It is a informal types of the trading without incurring a real transaction. There is no real transaction. Trader bet on the stock price movement, but that will not be real transaction. Okay, so there are no proper records. No records help the Dabba trader escape the taxation. So that's why recognizing as a offense under the Security and Contracts Act of 1956. Security Regulation Act is there 1956. So Dabba trading is not according to the legal norms. Next is the foreign portfolio investment. So FPI. What is FPI? So FPI is a SEBI is releasing the consultation paper on the framework mandating additional disclosure from identified high risk foreign portfolio investment. It is a high risk. This investment is high risk investment, and SEBI is disclosing this paper, consultation paper. So regulated by the SEBI first of all. So FPI is regulated by the SEBI. Okay, and prescribe certain limits on the investment, that is from the SEBI. Legislation provision, Foreign Exchange Management Act, FEMA Act is there. So FEMA Act of 1999, which is primary legislation for the FPI. So FEMA Act, you know about the FEMA Act, the Foreign Exchange Management Act, and this is the primary legislation for the FPI. So Prevention of the Money Laundering Act, that was in 2002, and the Prevention of Money Laundering Maintenance Record Rules. There are additional legislations. So two legislations are there for the FPI. First is FEMA Act 1999. Second is the Prevention of Money Laundering, and that act was came in the 2002. So these two acts are regulating the FPI, foreign portfolio investment. So comparison of the FDI and the FPI. See, FDI is an investment made by the foreign investor to obtain a substantial interest in the enterprises located in different country. So FDI is an investment of the foreign investors, which is obtaining the substantial interest. Okay, they want to obtain the certain interest from that. And FPI is a this is investing in the financial asset. So this is investment in the assets, and this investment is for the interest. Okay, so this can be in stock bond available on the exchange. So the FPI is working for the stock. If you are investing in stocks, if you are investing in the bonds, and that is for the asset generation, and the FDI is generally for the interest generation. Okay, so this is passive investor. So FPI investor are the passive, they are indirect investment. This is very low control, like there's very low control on FPI. And short term investment also, this is hot money, short term investment, financial asset of the foreign country, this is included in this and relatively easy. This one is easy one. And the FDI is basically active investors are there. Direct investment will be there always, high control. There's a high control of the countries, and long term investment. This for the long term. That's why this is very safer for the countries. Physical asset of the foreign country is included in this. So there's a physical asset, but there's a financial asset. There's a bond, stock markets, and all that involved in the FPI. And physical asset like construction, buildings, school, and education kind of things, factories, that is included in the FDI. And this is difficult, but this is easy. FPI is easy and FDI is difficult. This is stable. FDI is stable for the country. That's why it increase the growth rate of the country if we have the valuable amount of the FDI in the country. So the enough amount of the FDI will increase our stability, it will increase our growth, it will be very beneficial for the investment, and controlling the inflation also. But FPI is volatile. We don't know when the currency is going to be removed from the market, and when will be the what situation. We don't have any idea about the FPI. So there's a Press Note 3. This Press Note 3 stipulation is required entity of a country that share a land border with India can invest only under the government route. So issue identification identified with the FPI. So first of all, it should be invest only with the government route. Government route से ही इसको investment करना है. That is given in the Press Note 3. Press Note 3. Okay, second, since Press Note 3 does not apply to FPI investor, the FPI route could potentially be misused. This can be misused because they are not applying the Press Note 3. So, failure to disclose relatively party transaction. So, they do not disclose the related party transaction in the FPI. Okay, and arrangement or deal between the entity with the common interest or the relationship by the companies. The framework for FPI allow indirect circumventing and disclosure requirement. There is an indirect investment in the FPI. So SEBI is regulating the FPI first of all. So there is a low risk FPI if government and related entities such as central bank and sovereign wealth funds are there. That is the low risk FPI. Low risk FPI is included if government entities are there, if central banks are there, and if sovereign wealth fund is there. Sovereign wealth fund is there. Moderate risk is included if investors are pension fund and the public retail fund. If there is a pension fund and public retail funds are there, that means that is moderate risk. High risk is all other FPI other than the pension, other than the sovereign wealth, other than the central bank. They are the high risk. So first of all, we need to enhance the transparency for the high risk, and additional disclosure should be, we should concentrate investment by the FPI, the size of overall asset under the management. So we if we are investing in FPI, so overall size will be asset under the management, that should be under the management. So two legislation were there. First was the FEMA Act 1999, and second was the Money Laundering Act, against the Money Laundering Act. So that was in 2002. So two legislation were there for against this. Okay. Now, next one is the corporate debt market. What is this? So, SEBI is releasing the framework for rolling out the corporate debt marketing fund. So, SEBI always release the fund framework for the corporate debt market development fund, and this fund is established under the alternate investment fund. We can say this is a alternate investment fund. Okay, so corporate debt fund is a alternate investment fund, will purchase investor grade corporate debt security during the market state. If there is a market state in the market, in that type investor can purchase the corporate debt securities from the market. So this is the alternate investment fund and a privately pooled fund established or incorporated in India for investing, and this was for the investing just. So alternate investment, and collected from the sophisticated investors such as the angel investor, venture capital. So two types of things are there. First is angel investors. Second one is the venture capital. So two type of the investments are there, angel and venture capital. That is in the corporate debt market. Investor grade refer to the quality of the company's credit, and the company must be rated as a BBB. So first is rating should be BBB or higher. Okay. Second objective is market stress should be reduced. A debt market face the redemption pressure in the open market. So that's why there's a long maturity period of this scheme. That's why they are facing lots of stress, and debt market always face the stress. So objective is will help the market by providing liquidity asset. So this will provide the liquidity asset to the market, liquidity assets to the market. Okay. So the fund aims to emulate the RBI liquidity support for bank in the context of corporate debt market. So contribution of the fund is mandatory for the specified debt oriented scheme and asset management company. So contribution should be with the debt management scheme and the asset management company, and tenure of this fund is 15 year, and it can be extended as per the SEBI mandate. If SEBI is mandating, then it can be extended the tenure. So what kind of fund is corporate debt market? It is an alternate investment fund, and this is a kind of angel investors in the venture capitals, and this fund is reducing the stress of the investors. That's why this fund is launched in the market for the open market and for the maturity period. And now there is a the investor grade should be BBB, at least the rank should be B and B, and the contribution fund shall be mandatory for the specified debt oriented scheme, and tenure will be the 15 year, and next tenure will be decided by the SEBI. So corporate debt market, that is included bond, that can be included bond, credit market, fixed income market. It is a fixed income market. Okay, so collection name given to the old trades and issue debt security. So this will issue the debt security, and that can be bond, and issue the corporate bond. So there's some companies issuing the corporate bonds, that is finance current operations and expand the product lines, open new manufacturing facilities also. So this is government debt market, broadly divided into government debt market, and second one is the corporate debt market. So government debt market, you know about treasury bills and G securities. In similar way, there is a corporate debt market, in that they include the bond and the stocks. So this is regulated. Regulation is by the SEBI, and regulation jurisdiction between the SEBI and the RBI. Okay, so SEBI plus RBI both are regulating this Security Contract Regulation Act of 1956 in this. Under the RBI regulation jurisdiction include the money market and the government security. So what RBI regulate? RBI regulate the money market. You know about the money market, and second one is the government security. Government securities are also regulated by the RBI. But status of the market of India, outstanding corporate bonds presently there. So we need to improve the GDP, and that is a 70% almost of the GDP. There's a corporate bonds in India. Okay, and the same figure for other emerging Asian economy like South Korea. There's 80%, Malaysia 50%, China only 40%. But we have 17%, like only 17% of GDP corporate debt market. Okay, so what is the significance of this market? First is investor needs. If some investor wanted to invest in the market, they can purchase that bond and they can invest further in the, and it is investor led economy. First of all, in the economic survey 2018 and 19, this was kept efficient allocation of the resources. So this can be useful in the efficient allocation of the resources, and health of the corporate balance sheet will be balanced with the corporate debt market. So it will reduce the corporate reliance on the external commercial borrowing. So if we are giving the export, we are giving the corporate debt market in the India. So now we are not going to borrow from the external market. So that's why this will balance the health of the corporate balance sheet, and which is subject to there will no volatility in the market now. That's why this was useful for us. So these three topics we discussed